Welcome to the FarrCast. We've got a great episode lined up for you this week to dive into what the Fed decision means for the markets, for politics, and for the pocketbooks of everyday Americans. Now let's kick off the show with your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It is the 18th day of September. Coming into the weekend here, I'm recording up in New York, up on Long Island. We're going to have Kenny Polcari join us here. We started season 9, folks. This is big. Season 9 on the FarrCast. Here we go. All right. The Fed met yesterday. As expected, they did cut rates by 1/4 of a point. They said they'd have 2 more rate cuts this year, 1 more rate cut perhaps next year. And then Jay Powell said that they were going to be cautious. They were going to be deliberate, they were adjusting things. They weren't really suggesting they were having a big change in monetary policies. And what that means is he's not moving to a real strong accommodative stage. He's trying to make things not tight. Now, this is typical Fed Jay Powell speech. He wants to be very measured. I've told you this for many years now. He wants to be measured. He wants to be deliberate. He never wants anybody to get too excited. Let me tell you, sit down and spend an hour with Jay, and you will not be excited, okay? You will not be excited when you spend time with Jay Powell. Now, if he's your partner on the golf course and, a couple of beers later, who knows? So we're moving deliberately. We're moving deliberately. President Trump's new appointment to the Fed was the one dissenting vote that didn't vote for the 1/4 point cut, voted for a 1/2 point cut, the only one. Speaking up for President Trump. That kind of sends a signal that perhaps he'll be a Trump representative in the Fed early on. Maybe that was for the president. Maybe that was for a headline. Maybe he doesn't really mean it. Only in time do you find out how these folks are going to settle in once they get into the Fed. So futures this morning, equity futures, based on this expected Fed action, have sort of reconsidered and gone higher. After the news yesterday, the Dow Industrial Average rose. S&P and NASDAQ both fell. All are up this morning. NASDAQ leading the charge, up 1 1/8% this morning. S&P futures up 0.8%. The couple of really other interesting things going on. The U.S. 10-year Treasury is at a 4.06. That's a little higher yield than when we went out yesterday. In general, we're hovering around that 4.05, somewhere in there. It's a rather low rate on the 10-year Treasury. Oil picked up just a little bit, $64.50 a barrel. Now, this is interesting because with those lower rates, you would expect to see a growthier environment, and $64 oil does not suggest that you're going to see growth. It also doesn't suggest that you're having troubles in the Middle East that could interrupt supply. That's usually those are the two things that'll drive oil higher, right? Supply or demand. And if the whole world's economy is really expanding and we're really growing at all parts around the world, when we had the big growth surge in China, oil was high and staying high. So the economy is not expecting some huge international growth right now. Gold is above $3,700 an ounce. Above $3,700 an ounce. That continues to be big. Now, gold as a measure of inflation, right? Because how many dollars does it take to buy the same ounce of gold? More dollars buying gold means that you've got inflation. If you see gold surge and more, it's typically a sign. Precious metals, copper, silver, all of those things you watch and see. And then finally, you look at the dollar, and the dollar is weaker on this news. The dollar has fallen. It looks like a very slight fall, but slight falls in currency, because currencies are so immense, mean a lot. So they're telling you it takes more U.S. currency to buy the same things that you did yesterday. For instance, if we go back a few months, a euro cost about $1.10. It now costs $1.18. I always think of it this way. If dinner in Paris were going to cost me $110 3 months ago, now going to cost me $118. I'm still going out to dinner, And I'd love to find it. Now, you know something? I don't want to find a place in Paris where I can have dinner for even $118. That's going to be a crappy dinner in Paris. Why? Because it's expensive and it's going to cost. So the Fed has said what it has to say. We've looked at economic data this week, and the consumer continues to spend. So is the economy good right now? Is it not good? Stocks are making all-time highs. No question, this is expensive. I'm sorry to go on so long, but we're ready for my friend Kenny Polcari right now, the chief market strategist for Slatestone Wealth, the CEO of Case Capital Advisors, voice of Fox Business News. Hello, Kenny. Good morning.
Hello, Michael. How are you? Congratulations on season number 9. Is this the first one? Am I the first guest in number 9?
You're the only important guest that we're going to have ever. This is actually the only second. This is the second one of these, and you would have been the first, except you weren't available last week. So this is your first available appearance on the FarrCast for season 9, and ready to go. This is an exciting time in many ways, isn't it?
It's a very exciting time. You hit the nails on the head with that intro monologue that you did. And yes, the Fed did it. We're not really surprised. He remains cautious. He didn't take rate cuts off the table, but he reminded everybody that he remains data dependent. So you can take from that what you want. I still think that we're going to get 2 more rate cuts this year. I'm just in that camp that that's what they're going to do. But if the data suddenly starts to turn over the next month or two, I guess that could change. In any event, markets are at their highs, and the way that futures are acting this morning, it looks like you would have thought that he slashed rates by 100 basis points and said everything's great and rosy. I mean, it's unbelievable to me that on the opening this morning we're going to make a new high on the Dow, the Nasdaq, and the S&P, and probably the Mag 7 with all the excitement that's out there. But again, I've been in the camp that I think we're stretched. I think this is going to cause us to be really stretched, but
So we're stretched and we're making new highs. Do you fade
Right.
this? Do you sell it? Do you take your profits? Do you say I
So
want
no,
more
so
cash on the sideline?
no, so as a long-term investor, yeah, like I'm not taking any money off the table. But I'm cautious on where I'm putting new money. I'm not chasing tech, but things like basic materials, things like healthcare, things like even consumer staples. It was very interesting yesterday. Consumer staples, which has been an underperformer all year, was actually one of the outperformers yesterday with a broader market. If you look at the different industry groups, there wasn't a whole lot of movement. They were up about 0.25%. Consumer staples were up 0.6. And financials, naturally, that was the big winner, up 1% yesterday on the back of that news. But consumer staples, which is typically a defensive sector and has been an underperformer all year, it's up 7%. So it's behind the S&P and really behind a bunch of the other sectors, was one of the outperformers yesterday, which to me suggests that while they like the idea, money was a little bit more defensive. They want to be in the market, but they want to be in a place that's defensive. And so consumer staples, I found that very interesting. That was one of the outperformers yesterday.
Okay, so talk to me about investing, Kenny. I got $1 million sitting here in cash. What do I do with it?
So I think you feed it into the market. You don't just jump all in, but you have to have it to create a diversified portfolio. I'd be a little bit slower in chasing tech. I'd have the exposure, but I'd be a little bit slower in getting in. I know you have to get in at some point if you're just starting out, so you got to dip your toes in the water. But I'd start to build a portfolio around some of the underperforming sectors right now, giving myself a little bit of exposure to tech, but then taking more advantage of it as we see it pull back. And I'm sure we're going to see it pull back. That's what I'd be more aggressive with tech.
Well, anytime I see a market that's doing what this one's doing, and we haven't seen this pullback and thing pull back in a while, we're getting up to 25 times earnings here for the
Right.
S&P.
Right.
You're at twice the historical average. So it's got to come down at some point, folks. Markets come back. Markets pull back, and different things trigger them. It's usually some kind of something that's unexpected. If it's not the Fed, it's something unexpected. So we're not getting that frustration with the Fed. Politically, they just did probably the perfect thing, and we're buying time for that. They bought time through the end of the year with this. Now we're going to go to a government shutdown. We're going to talk to Mahaffee about that this morning. We're also going to talk to Stephen Cates from Bankrate.com this morning, an economist, to tell us what their Surveys are saying the consumer's feeling. That's really important, but I can already tell him the consumer's spending. I saw the data this week, consumer spending. So we'll take a look, hear what he has to say, and we're going to paint a picture because remember that the U.S. economy is 2/3 built on consumer spending. That's the most important thing to remember. 2/3 of your customers are of any company, if 2/3 of your company, of your customers are in one camp, you pay a whole lot of attention to that particular camp. So that's where we are. That's what we're going to do today on the FarrCast, and we're going to try to help you figure it out. Polcari saying you dip a toe in, you always try to get invested. There's always something cheap out there to buy, but this is not cheap. He and I both expect a pullback in here somewhere, and we can't tell you when and why, but it doesn't stay this high this long. Kenny, give us a final word here for Fred and Ethel, and tell us where you think we end up at the end of the year in stocks, and where do you think we end up in interest rates if the Fed does keep pulling back on the short end? Does the 10-year move materially?
Listen, I think the 10-year is very interesting. The 10-year had the opportunity to break 4% yesterday because yesterday morning it was sitting right at 4% ahead of the Fed meeting. The fact that it didn't break 4% suggests to me that investors are still concerning themselves about inflation, right? The low was in April at 3.75%. That's going to be the level to watch, right? If it breaks 4, you got to watch to see if it holds at 3.75. I think it's going to end up somewhere between 4 and 4.15-ish. I think that's where 10 years are going to settle. I thought the S&P was going to end right here at about 6,500 at the year end because I expected the pullback and then the rally back into year end. Clearly, I'm wrong there because we're already at 6,600, and by the opening, we're going to be at 6,660. And so I have to rethink kind of where I'm going to be. But unless we get a pullback, certainly it's not going to be where I thought we were going to be. And it's going to be interesting to see how, to your point, investors react with trading at 25 times earnings, right? Because it is expensive.
This is expensive.
Right. So I'm going to remain invested, but cautious with my new money, very strategically on how I'm going to place it.
Kenny Polcari is Chief Market Strategist for Slatestone Wealth, the voice and face of Fox Business News, and my dear friend. Thanks, Kenny. We're coming back with Mahaffee. Please stay with us.
Thanks for being with us on Season 9 of the FarrCast. And now, political analyst Dan Mahaffee and your host, Michael Farr.
Welcome back to the FarrCast. Joining us now, Dan Mahaffee, president of the Dr. Scholl Foundation, a scholar at the Center for the Study of the Presidency and Congress, and our senior political analyst on the FarrCast, now in Season 9. Can you believe it? Dan, welcome back.
Good morning, Michael. Thank you.
How are things in Chicago?
Oh, they're well. You know, a lot of the concern, I think, over the major National Guard deployment
Yes.
Has passed, but there's still a lot in the press here about ICE raids, things of that nature.
The National Guard concern is passed because you don't think they're showing up anymore. It's too much risk versus reward for President.
I think that, and also I think we have to remember there's very different legal frameworks compared to the District of Columbia versus a state with a governor like Illinois. So that's why, you know, they had to move to where they would have a cooperative Republican governor, and I think that's why Memphis is now where you see in the headlines the National Guard will be deployed.
I've spent time in Memphis in recent years, had an office in Memphis for a long time. You don't feel particularly safe in Memphis when you're walking around. You do have to watch yourself depending on which neighborhood you're in. It's like any other major city, I think, but it can be very dicey very quickly. All right. This week, the Fed met, and that's top of our list here. And we got what we expected. Wall Street got just not, it wasn't a little too hot. It wasn't a little too cold. It proved to be just right, I think, for Wall Street. Markets didn't quite know what to do yesterday. They've recovered this morning, and they've decided that they're bullish. So share prices are on their ways to making even higher new all-time highs. We have a new Fed governor that joined the Fed for that meeting, Stephen Miron, President Trump's appointment. And after he was sworn in Tuesday, Powell gave little indication, CNBC says, of tension in the air. The only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make a really strong argument based on the data and understanding of the economy. And that's all that really matters. And that's how it's going to work, Chairman Powell said, according to CNBC. So there was one dissenting vote in spite of all of that. This cut came at 0.25%, and Mirren was the one dissenting vote, voting for a 0.5 point cut at this point. So Powell threaded the needle. 2 more cuts this year, 1 next year. We'll see if it all happens. It gives him time for the data, as I've been suggesting in my videos and comments in the media. Powell will want to buy time and see more data. The critics say data is in the rearview mirror, and therefore the Fed's always too late. And my response is, what do you want them to do? Do you want them to anticipate data? Do you want them to guess what's going to happen? I mean, this is the Federal Reserve. This is the direction of the largest economy in the world. So it seems that that's going to quiet down for now. Dan, do you have any thoughts about these Fed appointees and appointments and what happens next?
Thank you, Michael. Yeah, I think we have one. Of course, you saw the meeting and you see that pathway towards the cuts, as you say, the data. And I simply look at it and, as we were saying here, have a proactive central bank at your own risk.
Yes.
I think that's one takeaway of this. And every time you look at it, how are you going to gauge who's going to predict it and who's going to predict it right if you're going to have a central bank that is trying to time things or be proactive? I just don't think that doesn't work,
right.
Frankly.
Right.
Yes, you have that. You have the pathway, I think, to more cuts down the line. But ultimately, the future of the Fed, those are the questions. One, you have on the Hill, look, Mirren got approved despite the fact that they were going to keep his seat on the Council of Economic Advisors warm for him. So that was always a question of what is his independence. We've long known, and as the chair said, Chair Powell said, yeah, you have to come with good ideas and persuasive ideas. I don't think the other Fed governors are persuaded by ideas like the third mandate or the Mar-a-Lago Accord or all these other things that Mirren has
espoused. The third mandate being whatever President Trump wants?
Oh, well, that's the prime mandate for any of these appointees. That's deep in the source programming before there's any other mandate. On the other hand, no, it's what Mirren has said is that, and this goes back to I think your excellent episode with Jeffrey Lacker, though. Is the Fed's job to keep long-term interest rates manageable? Is that a third mandate? Because that has not been on there, but Mirren has spoke of it as being one that he sees the Fed as responsible for. And I think that goes back to, of course, what the president has said on borrowing costs and his preferences.
Right. Okay, Dan, we're quickly approaching what could be another shutdown in Washington of the government. Budget talks. Tell us what the discussions are about and why the government might shut down, and then we'll talk about whether you think it's going to happen or not. But please just set for our listeners.
Well, right now, I wouldn't say there's discussions. What I'm seeing is sniping in the press. There are at least plans being put forward, and there is coordination between the various appropriations chairs and ranking members. But as it stood last night, there haven't been many productive, if any, conversations at all between the four corners, as it's known, the leaders in the Senate and the Speaker and the Minority Leader in the House. So absent those discussions, right now, I think both sides are putting forward their plans. We're going to see clearly the House will move on its plan, but I think that's dead on arrival in the Senate because you need to get 60 votes. So shutdown of some kind seems likely unless you get some sort of deal on the healthcare side, but I see both sides digging in. And ultimately, if there is something that does get a deal done, it's simply because if they want to move, and I think it's after last week's tragic events, even more of a pressure to unlock the millions of dollars that they want to use for funding security for lawmakers, judges, other officials. So they want to put a significant amount of money towards securing elected officials, and they can't do that until they move some of this other stuff. So that plus, of course, as we always say, the fumes of jet fuel of getting away. Those are the incentives for them right now.
So
But
what happens, Dan? What
even
happens?
if they do make a deal, Michael, we end up just doing this all again, right again before Thanksgiving.
We do it all again before Thanksgiving. Do we have anything to worry about now, or is this a kick the can moment once again?
This is once again a kick the can moment with a short government shutdown of some kind. But I think, again, while Democrats feel the need to fight after not doing it last time, so much of their concern is about what happens in a shutdown where the administration gets to decide, for better or worse, how they want to spend the money themselves without congressional input.
I've been reading just to change, as now that you're talking about what the Democrats feel they have to do. Of course, I've been reading my friend Leland Vittert's War Notes. It's always interesting to read War Notes, these are notes that he comes out with the outline of his show and his thoughts before he gets on air. And I love to see an anchor's thoughts before they get on air to see how they change when he's on air with guests, and they often do. But Leland has been saying loudly and clearly, and he's going to be a guest in the FarrCast here talking about his new book coming out here next week. I think it's next week. And it's a fabulous new book. I had tears in my eye. I mean, truly tears in my eyes about a half dozen times and burst out laughing a couple of times too. It's an amazingly powerful, touching book coming from my friend Leland Vittert. It's called Born Lucky. Born Lucky. But he has been saying that the Democrats are basically floundering, and that he's critical that their biggest position is to criticize whatever's going on with the administration or immigration. He just says, your message is completely wrong. You don't have a clear agenda, and people are looking for leadership, and you're not providing it. Shame on you. And he's on this saw pretty hard. What do you say, Dan?
Well, I say to that, yeah, Democrats do have that problem because, like both political parties in the United States, there is a big delta between where the grassroots members stand and where the electeds who've been in Washington much of their life are. So, in the Democratic Party, those who are, older leaders in power, the Schumers, the Pelosi's, they're miles away from what you see of the campus Democrats, young people. And look, the social media and what they want in some ways speaks for itself. But it's not that different than the gap you saw in the Republican Party. And frankly, Donald Trump, if we look at the history of the party, was just a accelerant that sealed up and transformed the Republican Party faster.
Yeah.
Moving it from the Bushes and the Cheneys to a more populist, more grassroots, more media-oriented party. And the Democrats haven't gotten there as quickly. One, because Republicans, just as a party, fall into line better. They always have. When you advise Republican candidates to say something, they just do it. A Democratic candidate will always say, well, why should I say that? And then finally, within the Democratic Party, you have this competition, of course, between different grassroots groups, interest groups, etc., where if the Democratic Party wasn't having the administration to solely complain about, they'd probably be sniping about each other more.
Right. And by the way, ladies and gentlemen, please remember our FarrCast from a week or so ago. Charlie Kirk and his assassination is reprehensible, is an abomination in America, where we do have free speech, even if you don't like it. And we don't kill people in this country. I think it's a particularly low moment for our country. And please don't interpret that as my opinion about anything that Charlie Kirk said or didn't say. That's not what I'm saying. I'm saying that in America you have your right to express yourself. That's that. Now that ABC pulled Jimmy Kimmel's show over his comments shows, I think, the volatile, powerful, explosive potential of these social political issues. I think we have to be very careful here, Dan.
Well, that and look, Michael, if you read into why it was pulled at the request of Nexstar. Nexstar is one of the largest affiliates of ABC Broadcasting of Disney. Nexstar is also, though, trying to merge with Tegna, the spinoff of Gannett's Broadcasting Networks. And in order to do so, these affiliates will breach the FCC 40% rule of owned affiliates, and therefore they need the administration's FCC chair to approve this. It's very similar to the CBS merger, as we saw with Paramount and Skydance. So it is an environment where a lot of these business decisions are going to be made with an eye towards how the president and his allies are using their regulatory power.
Dan, we're running out of time. Let's quickly move to Ukraine, Russia, Poland, NATO. Tell us what's going on there in your read, please.
My read there, of course, is that the European allies, look, we said they needed to be woken up. If this is pushing them further, we see it positively. We see them continuing to look at how they can support Ukraine. But Putin's no nearer towards the negotiating table. There's no way that you see the Russians softening anytime soon. So again, when does the president's patience run out with Putin? We're still seeing, and then finally, as the president has said, they are going to up the pressure, but they also need to see the Europeans put pressure on China, put pressure on India, and I see it as no coincidence. At the same time, the president is telling the Europeans to put pressure on China over Russia. The Chinese are making it very hard for the Europeans to get their critical mineral exports.
And finally, Dan, let's move to Israel, Middle East. Now, I'm skipping over China this week. We'll come back to China next week. But finally, on Israel, Netanyahu continues his assault. The world is still putting more and more pressure on him. How does this resolve? How does this end? What happens in the Middle East? And we got to go.
Well, absent us stopping Netanyahu's vision is that a Israeli flag is planted on a pile of rubble where Gaza once stood, and he can declare victory over Hamas.
When can he declare victory over Hamas? I think he could probably do it now, couldn't he? Do we have to wait?
Well, that's the question of the hostage return and whether he thinks that this military attack will ultimately free them or as the negotiations go on. But look, the Wall Street Journal today has a very good piece of breaking down why President Trump gets so seemingly ticked off by Netanyahu, but then in the end, no consequences seem to come of it.
Dan Mahaffee, president of the Dr. Scholl Foundation, senior political analyst on the FarrCast. Thank you very much, Dan. Coming up, ladies and gentlemen, Stephen Cates from Bankrate.com. How does a consumer feel? And what's happening to mortgage rates? And are folks coming back to the refinance trough? It sure looks like it. When we come back on the FarrCast.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast. I'm Michael Farr. Terrific FarrCast so far, starting with Kenny Polcari, And then we moved to Mahaffee to figure out what's going on in Washington. And there's a lot, but it still seems very murky. And at least we heard kick the can is what's going to happen next in terms of a government shutdown or resolving budget and spending and everything else. No surprise there, but we're going to do it again at Thanksgiving, folks. So watch the 10-year, watch your wallets, watch the volatility, because Washington will continue to be a source of volatility as best it can, certainly keeping the attention focused on Washington. Now, we've got a great new guest from Bankrate.com. We're very, very excited this morning. You all remember that my great friend Mark Hamrick, of over 30 or 35 years as friends in the media and on TV and radio and everywhere else together, he said, I've got a guy for you, Farr. You need to talk to this guy, Stephen Cates. He's great. He's with Bankrate now. You're going to love him. He's a CFP. He's been in the business for 15 years. He's great at this. He's done all sorts of media from NBC and CBS and Fox and everywhere else. Stephen Cates, we're so excited to have you here. Welcome to the FarrCast.
Thank you so much. Very warm welcome. I'm happy to be here.
We're really happy to have you here. Let's start with a little brief discussion, if we can, about the Fed meeting, because I want to move very quickly to the consumer's reaction, because we've seen consumer spending, and at Bankrate.com, you have a particular purview into the consumer, what people are feeling, what they're doing with refinancing, how they're feeling about credit cards and debt and everything else. We've got to get into this for our listeners today. But Stephen, you watched the chairman yesterday, and what I have described as a meeting and a message that had just enough disappointment in it for everyone to be about perfect.
I think so. I'm fond of the phrase that compromise is the agreement that leaves everybody unhappy. And I think that's probably what we got. I think some people still wanted a 0.5% rate cut, even though the Fed clearly telegraphed we were going to have.
Well, one did. Stephen Miller, the new governor and the new Trump appointee, did in fact vote for a 0.5%, but nobody else.
He did.
Paid attention.
And he stuck out like a sore thumb on the dot plot.
But he carried the water. Good for you, sir.
He did his job. I think that, he put a stake in the ground that he was doing what was asked of him. And I think it was interesting that, Chair Powell said in the meeting that there was not broad support for 50 basis points, as a slight nod to the fact that no one else, I think, probably had any indication that was going to happen. But still, the market, sort of yo-yoed a bit, during the press conference, but ultimately we ended flat. Or roughly flat yesterday. And I think that's just an indication that everything was pretty priced in.
Everything was pretty priced in. So now we are in this range of 4 to 4.25 for Fed funds rates, ladies and gentlemen, 4 to 4.25. That means that money market rates will drop by about 0.25 point in general across the board for short-term money. They promised another 2 rate cuts at 0.25% in 2025. Indication, not committing to. Powell tries to be very careful, and Wall Street immediately writes it down in hard black ink as if it can never be changed or written over. That's Wall Street's mistake, as I've talked about for years. Wall Street loves to create its own narrative to suit Wall Street's bullish interests. Whether Powell has said anything similar or not, Wall Street tries to lead him there, and Powell's not a leadable guy. Remember, I've known Jay for 30 some odd years. He's very, very deliberate. Okay, and then another in 26, and then another in 27. So theoretically, in, 24 months, we could see rates 3 to 3.25, right? Because that's 2 more 0.25 point cuts this year, 0.25 in 26 and 0.25 in 27. We're really stretching it out here. And I'm seeing this as Powell trying to say we're going to normalize things. We are not changing direction in policy. We're not saying that this is going to be accommodative and therefore we're going to have stimulative, accommodative monetary policy. I think that this is a making right, a getting right of where we have been, a slight adjustment, a bit of tweaking over the next couple of years to get us to that all-elusive and ideal Valhalla of a neutral rate out of the Fed. Does that make sense to you, Stephen?
I think so. When we look at how this compares to the June summary of economic projections, it's we've got some different sort of forecasts of GDP and inflation and whatnot. But as far as policy rates go, there's only one additional cut now that's sort of baked in across all three of the next, 25, 26, 27, and so it's really just one additional cut. It's not holistically different. We're just upping the pace a slight amount in terms of the, when they're cutting. And as Powell said, a bit of a risk management cut. The risk he's managing, I think, is probably a little bit of the economic side and a little bit of the political side.
Right, right. So I think that's very well said. Little political, little economic. I tend to think perhaps the president leans a little more to the political side right now than he does the economic side. Okay, that's my prejudice. Having listened to him, that's not a political comment, ladies and gentlemen. That is based on my experience and listening and watching what the president's doing in these things. All right. So, Stephen, what about consumers? The consumers, 2/3 of the U.S. economy. How are they reacting? We're seeing a number of refi applications increase. What does all of that mean? What are you seeing at Bankrate?
We're seeing a huge influx of interest in refinancing, and I think rightly so, with mortgage rates having come down, from over 7 to now about 6.25 or so. And all of that depends on credit scores. We don't need to get into the nitty-gritty details of how you get a rate personally, but rates have come down, and there are people itching to tap some of their home equity through cash out refis, through home equity loans. And I think that that's just beginning. This is sort of the starting gun on the fact that we're going to have more cuts. We're going to start to see rates potentially, decrease in the future. And the consumers are itching to tap some of that equity from their homes and, keep the debt rolling a little bit. The bottom half of the income, scale in the U.S. is struggling significantly more than the top half. And we're seeing the evidence of sort of this K-shaped economy start to spread out. We've got delinquencies on student loans and personal loans and other things rising. The people who are getting that, they are typically those who are less financially stable. Whereas you look at the top half or even the top quarter of income earners, they are spending like crazy. They are carrying the economy.
This is so good. This is so good because you took me exactly where I was going to interrupt and take you, and you did it without me.
Good.
God bless you. That was terrific. So so two questions, because I want to talk about the bottom half and I want to talk about the top half of consumers and spenders. And yes, when you see this surge in refis or trying to get home equity loans, are folks doing that because of some sense of optimism or from a sense of desperation? Meaning, if I don't have money, if I'm in that bottom 50%, if my bills are too high and I just need to cover stuff, that's a bad reason to take a home equity loan.
Very bad.
And we're seeing the buy now, pay later websites that people are using to buy groceries, for God's sakes, and that's widespread. That's not an aberration. So if the lower half is suffering, and if they indeed are having difficult economic times, what does that mean? What does that tell you? And then we're going to jump to the high end that are doing a whole lot more spending than they used to, and what that tells you. But let's start with the low end. How do you interpret that?
Well, so I think that, within the low end, there are segments of the population that are absolutely, extending, debt to sort of support the lifestyle that they're on or keep themselves afloat. One of the things that's certainly, not looking very good for the economy is the fact that, recent graduates who are most likely to have high levels of student loans, their unemployment rate is at one of the highest levels that we've seen in numerous years. We've also seen, Black Americans, minorities, their unemployment rate also spike relatively recently. So those things, people at the margins of some of the employment are seeing that they're in trouble, that they're suffering, and they're the most likely to have to extend some debt, whether it's credit cards, whether it's personal loans, whether it's tapping whatever's available to them to sort of cover some of these gaps. That's a particular position that people are finding themselves in, and we are starting to see that. With rates as high as they are, people are itching for refinancing opportunities, debt consolidation opportunities. I don't think that's going to change anytime soon.
So refinance and some of these lower rates means I can lower my monthly expenses by refinancing and having rates, and I'll have a little bit more money. And maybe I need to take a home equity loan that I can afford now, that it might make sense to me in order to pay for some things.
Mhm.
I want to watch this, Harry Jennings, make sure we're watching this very, very closely in all of our data banks that we follow all the
Mhm.
time on the FarrCast. Make sure that we're up to date with information for you. But
I think I could add in,
please,
you could probably bifurcate, and this is true of lower and sort of upper income, groups, those who own homes and those who don't, because there's going to be a significant divide, honestly, between those populations, those who have a home or owned a home going into, let's say, 2020 or into the pandemic, or even bought shortly thereafter. They're sitting on enormous amounts of home equity. We've seen 50% increase in the levels of home equity across the country
right,
just since 2020. We did a recent survey on this. We are more deleveraged as a home ownership population than we've been in a very long time. And that's actually a pretty good position for a lot of homeowners to be in. This isn't 2008 all over again where people are leveraged to the hilt. People are in a very good position. Looking at various states, especially states with older populations, like a New Hampshire, for instance, their relative level of sort of debt to debt to equity is 40%, 50%, for the entire state.
right,
Of looking at all homeowners, which is a very good position to be in. People have room to tap home equity and to do that,
right.
and that
Do
puts
they
them
have the
a little bit more of a
flexibility?
stable position.
Right. That's terrific. Let's go to that high end and let's end on the
Mhm.
on the high end. That top 10% are now responsible for about 50% of all of the spending
Yes.
that's going on in the country. We have said and we have followed income and wealth disparity for years because the issue there, Stephen, is the velocity of money. When you have a whole lot of money in very few hands, doesn't matter how much money they have. You can give them $1 trillion each. They can only move but so much
Mhm.
of it in a 24-hour period, 30-day month, 365-day year. You can only move so much. So if you want velocity of money, if you want the money to get out and move through the economy, you've got to put it in more hands, and more hands mean those who have less. And those who have less,
Mhm.
by the way, will more reliably spend it. So the high end has started to spend, probably because of what you were just talking about. You take a look at those homes and real estate homeowners that have much more equity in those homes, much more appreciation. Likely a number of those will also have stock portfolios that are up and other assets that
Mhm.
are up, and business owners that are more highly valued, and they're feeling a little fluffy that they can go out and spend, and indeed they're
Without a
doing it.
doubt.
Is
The
that
wealth
enough?
effect is
What's the
huge.
sign there for you, and is there a concern?
I wouldn't say it's a concern. I think if they weren't spending, I think that would be a huge concern because they're currently carrying a lot of the economy right now. If you chart out, by sort of decile some of the spending that we're seeing, people on the bottom half, even the bottom three quarters, of the economy, they are spending at a rate that is not too much higher than the rate of inflation. Whereas the top 25%, top 10%, certainly, they're spending well in excess of that, and they're just really cooking. And part of that, I think, is the wealth effect that you spoke to. One of the things that's interesting to think about is the fact that higher rates created an incentive for a lot of people to probably spend more because they felt more flush. If you're getting 4.5% on a money market account, and you're in a position where stock market is going bananas, you've got all of this excess cash that you can go spend. I mean, I can speak personally. My retired parents are booking vacations on their vacations. They are just doing it right, and they're living. This. Well, I couldn't be happier for them. As somebody who used to do a lot of retirement planning for couples, it's amazing. They're living the way you should live in retirement, but it's because they have growing stock portfolios. They have juicy returns on bonds and money markets. And a lot of people in that position that are retired or are retiring, they're ready to go. They're ready to put that money to work.
Do you tell them what my children tell me? Hey, slow down, Dad. Think about your heirs. I mean, you know,
My dad likes to remind me that if he doesn't fly first class, then I'll have to fly first class.
and I've had that conversation, and my children are fine with that.
Yeah, and I'm fine with it too. I think they should do it.
Yeah.
But that's, I think you broaden that out to the enormity of
Yes.
the sort of the retirement, cohort, and you've got a lot of people spending. The level of and share of consumption for older Americans, 65 plus, is growing and will continue to grow for the next
Yes.
few decades. They're
Yes.
going to be an enormous part of sort of pushing the economy forward. And I don't see that stopping unless we have a really protracted recession with, sort of just grinding lower on the market.
Right. So Bankrate's seeing things pretty much okay then, with some concerns and pockets of concerns here and there. You're largely constructive, it sounds, on the U.S. economy overall at this point.
I am. I think that the economy, we're hitting some bumps and getting some bruises for sure, but the economy overall, I think, is relatively in good shape. It's worsened, in terms of the unemployment rate. It's higher than it was last year, but 4.3% on unemployment. If you look at that and even some other metrics, that's in the 10% lowest reading that we've seen historically. Over the
Not
last
bad.
50 years. It's not bad, but it's worsening, and I think that's one of the reasons the Fed is potentially making a little bit of a move here to try to arrest some of that, because, at the margins, some of the less financially stable people, whether they, you look at recent graduates or others, they are in trouble. They are feeling stagnation. They are feeling poor sentiment, and that's not good. We certainly don't want people feeling hopeless about the economy, when they're younger, while the older people, are feeling exuberant about their ability to spend.
Stephen Cates is a CFP. He is Bankrate.com analyst, and I'm glad they have you as a spokesman, as you help, as it says in your bio, demystify for listeners, clients, and Bankrate subscribers. They're lucky to have you, Stephen, and we're lucky to have you on the FarrCast. Thank you for being with us.
My pleasure.
That's it for another FarrCast, ladies and gentlemen, as we cover Wall Street, Washington, and the world, bringing you experts and insiders each and every week so that we can better understand what's going on in the economy, what's going on in Washington, what's going on in markets, what's going on in global affairs, so that we can better understand the world and then make decisions about our portfolio, about our lives, and that we do it from a position of empowered understanding. That's what we want to bring you here at the FarrCast. We hope you learn each and every week. On behalf of my producer, Harry Jennings, Hightower, everybody at Farr Miller and Washington, thanks for listening. Please share us on social media. In New York, I'm Michael Farr. We'll see you next week.
And that's a wrap for this week's episode. Thanks to this week's guest, Kenny Polcari, Dan Mahaffee, and special guest from Bankrate.com, Stephen Cate. And thanks to you, our listeners. We hope you'll share us with friends and colleagues. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that any time we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And if we can be of assistance here at Farr Miller in Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'll be happy to put you in touch with one of our investment professionals to help you navigate your financial course across the changing investing landscape. We are grateful for all of your notes and comments, and we try to respond to as many as we can. Please keep those emails and messages coming. We'll be back with you next week with scheduled special guest, Dr. Jay Bryson. Stay with us in coming weeks as we bring you a wide range of guests from across Wall Street, Washington, and the world. And until then, take care, stay safe, and stay healthy. And thank you for listening to the FarrCast. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors LLC. Securities are offered through Hightower Securities LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors LLC or any of its affiliates. Farr Miller in Washington and Hightower Advisors LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.